Last episode, we talked about what seeds do to your body. Today, we're talking about what seeds do to your bank account and your future. Because in the world of finance, a seed isn't something you sprinkle on yogurt, it's the very first dollar that starts an empire. Welcome to Rooted and Rising, where we focus on becoming whole through the mind, body, and spirit together. My name is Lamisa. Let's start right at the beginning. When people hear the word seed capital or seed funding, what does that actually mean? Seed capital is the initial funding used to start a business. Think of it exactly like a seed in the ground. It's the earliest, smallest investment that hopefully grows into something much larger. This money helps a founder go from an ideal or a prototype to a real operating business with a product, team, and maybe even early customers. But how is seed funding different from other types of investments? Startup funding moves through stages, and seed is the very first. Before seed, you sometimes have pre-seed, which is often just the founder's own savings or money from friends and family. After seed comes Series A, then Series B, then C, and beyond. Seed is where the earliest believers show up. That means seed investors are taking the biggest risk by far. When you invest at the seed stage, there may be no product or revenue yet. You're essentially betting on a person and an idea. The risk is large, but there is so much potential reward. Some of the greatest returns in venture capital history have come from seed investments in companies that went on to become household names. So basically, seed capital is the very first formal funding a startup receives. Typically, seed round size is $250,000 to $5 million. This money is used for product development, early hiring, market research, and initial operations. Investors receive equity, which is ownership, in exchange for capital. Pre-seed versus seed. Pre-seed is often informal. Seed involves more formal term sheets. Average seed investors hold equity for 7 to 10 years before a liquidity event. Let's say you have an idea. Where do you actually go to find seed funding? The first and most common starting point is bootstrapping, which is using your own personal savings. Many founders start here. It forces discipline because you're spending your own money. The second source is what's called friends, family, and fools, sometimes shortened to the 3 F's. These are people in your personal network who believe in you enough to write a check, often before there's anything tangible to show. Be crystal clear about the risk. Don't take money from Aunt Carol unless she genuinely understands she might lose every dollar. And put everything in writing, no matter how close you are. Many relationships have been permanently damaged by informal money agreements gone wrong. More formal channels are angel investors, who are high net worth individuals who invest their own personal capital in early stage companies. Angels are often former entrepreneurs themselves, and they can bring tremendous mentorship value on top of the money. Then there are seed stage venture capital firms, which are dedicated funds that specifically target early investment, and accelerators like Y Combinators and Techstars, which provide seed funding in exchange for a small equity stake, along with a structured program and a powerful alumni network. Since the Jobs Act in 2012 opened the door for everyday Americans to invest in private startups, platforms like WeFunder, Start Engine, and Republic have allowed founders to raise seed capital from a large crowd of smaller investors. This can also serve as a powerful marketing tool where your investors literally become your community. If you're pitching to a seed investor, what do they actually care about at this stage? At the seed stage, investors are primarily betting on the founder, not the product, not the market, the person. Do they have grit, domain expertise, resiliency? What they're really looking for is a large addressable market. They want to see that you understand the problem deeply. And they want early signals, customer interviews, wait lists, beta users, any indication that real people actually want what you're building. Many investors prefer co-founding teams over solo founders simply because startups are brutally hard and having a partner through the difficult moments matter. That said, exceptional solo founders absolutely get funded. The key is showing you understand the gaps in your skill set and have a plan to fill them. But what kills a pitch? A few things. Founders who can't clearly explain the problem they're solving within 5 minutes, that's a red flag. Unrealistic financial projections with no basis in reality, red flag. No clear understanding of who the customer is, red flag. And arrogance, big red flag. Investors at the seed stage are looking for coachable people who are willing to learn and pivot when necessary. The best founders are confident and humble at the same time. Let's turn the table. What if you're not the founder? What if you're someone listening right now who just want to invest in early stage companies? Can you actually do that? Actually, yes. Historically, early age investors were limited to accredited investors, people with a net worth of $1 million or income about $200,000. But regulation has democratized this majorly. The platforms to know: WeFunder, Republic, Start Engine, and Mainvest. You can browse active fundraising campaigns, read the company's disclosure documents, and invest anywhere from a few hundred to tens of thousands of dollars. Most startups fail. The majority of seed stage companies will never return your investment. This is a high-risk capital, money you should genuinely prepare to lose fully. There's also illiquidity. You're typically locked in until the company is acquired or goes public, which can take a decade. The best practice: invest small amounts across many companies and treat it like the high-risk portion of your portfolio, not your retirement fund. Angel investors who succeed long-term rarely win on one big bet. They make 20 or 30 investments, knowing that one or two might generate returns large enough to cover all the losses and then some. Diversification matters here just as much as anywhere else. There's something deeply powerful about the concept of a seed in personal finance. And I think this is the piece that applies to almost everyone listening. The seed mindset in personal finance means this: you have to plant something before you can harvest anything. Every dollar you invest today is a seed. Every skill you develop is a seed. Every relationship you build in your industry is a seed. Growth is always downstream of planting, and time is the soil. The number one mistake people make with investing is waiting until they have enough money to begin. Thanks to compound interest, the seed you plant at 25 is exponentially more than the one you plant at 45. Even putting $50 a month into a broad market index fund is planting a seed that compounds over decades into something genuinely significant. Quick definition: compound interest means you earn returns not just on your original investment, but on all the returns you've already accumulated. Einstein allegedly called it the eighth wonder of the world. Time is the most powerful variable in investing, and seeds need time to become forests. So what's the practical seed portfolio for someone just starting out? Here's how I think about it. Your emergency fund is your first seed. 3 to 6 months of expenses in a high yield savings account. That's your foundation and your safety net. Then capture any employer's 401k match. That's a guaranteed 50 to 100% return, which beats any investment in the world. Then IRA contributions for tax advantage growth. Then broad, low-cost index fund investing. And for those who want a little adventure, a small slice in high-risk assets like individual stocks, REITs, or equity crowdfunding. But always plant the boring seeds first before reaching for the exotic ones. Let's have some fun. When you look at the history of seed investing, some of these stories almost feel like myths, but they're real. and they teach us something important. Peter Thiel, $500,000 seed investment in Facebook in 2004 turned into over $1 billion when the company went public. That's roughly a 2,000 times return. Sequoia Capital's early investment in Google, around $12 million at the time, returned billions. Mike Markula wrote Apple a $250,000 check in 1977 and received a third of the company. These almost sound like fairy tales, but here's what they all have in common. In each case, the seed investors saw potential that others dismissed. They invested when the outcomes was genuinely uncertain. They had convictions based on the founder's vision and the scale of the problem being solved. And they were patient. None of these returns happen overnight. The takeaway for ordinary investors: believe in things that others aren't paying attention to yet. The best seeds often look unimpressive at planting. Amazon looked like just a bookstore. Google looked like just another search engine. Conviction, patience, and diversification. That's the seed investor's trinity. And honestly, that principle applies whether you're investing $50 a month into an index fund or $50,000 into a startup. You plant, you tend, and you trust the process. That is a wrap on our full series, The Power of Seeds. From your plate to your portfolio, seeds represent one of the most powerful forces in both nature and finance. The capacity for small things, given the right conditions and enough time, to grow into something extraordinary. Here's what I want you to walk away with today. Every wealthy person starts with their first investment. Every thriving company starts with the first dollar. Every healthy body starts with the first habit. The question is never whether to plant. The answer is always start now, start small, and trust that growth follows. If this series connected with you, share it with someone who needs to hear it. A friend starting a business, a family member learning about nutrition, or anyone who could use a reminder that it all starts with one small seed. Until next time on Rooted and Rising.